first off, thank you all of you for turning up. It's a Saturday afternoon, and on behalf of the CFI team and everyone else who helped organize this event, thank you for showing up. I'd just like to introduce Monish to all of you. Monish began his career with Tel Labs before he founded his own IT consulting firm, Transtech, which he later sold to Kurth Sum & Associates. And that's when he made the switch to money management. He founded Pabrai investment funds in '99. He's perhaps best known for bidding $650,000 for a charity lunch with Warren Buffett. And he's adopted Warren Buffett's value-based investing approach for his own funds, and he's even authored 2 books on the same approach to investing. Today he works with the Dakshina Foundation, which he helped found in 2005, to focus on alleviating poverty by helping to tutor underprivileged children and enabling them to attend some of the country's best institutes of higher learning. And I can see a lot of you out here today. But without any further ado, I'd like to give you Monish Pabrai.
That warm introduction, and I'll let you know when we'll start. But right now, let's keep the screen on. So, but anyway, great to be back at ISB, and thanks for having me back. I think last time I was kind of winging it, so this time I thought I'd do a little more prep. And again, I think before I launch into compounding and investing and so on, I just wanted to share just a little bit of a couple of thoughts I had on ISB, actually before there was an ISB. And I used to live in Chicago in the 1990s, and in the mid-90s, early to mid-90s, some of the professors at Northwestern University, Kellogg School, and Rajat Gupta and such would talk about this Indian School of Business in a, it was kind of, much of it was in their heads. And I'd even, I think, one time broken bread with Rajat, of course, known him for a few years. And of course, here we are today. We have an amazing institution that's thriving and doing really well. And I just wanted to actually spend a minute or two on Rajat, because I think that even if you don't get any value from the presentation I'm making, I think there's you can say, a Shakespearean value in some of the events that have transpired. And my heroes, Warren Buffett and Charlie Munger, say that envy is one of the worst of all the human vices that you can have. In fact, many other human vices you can get an upside from having those vices, but with envy, if you have envy towards anybody, all that's going to happen is you're going to feel bad. And in the case of Rajat, he was off the chart successful, but his downfall was led by 2 things. I think the 2 traits, basic human traits. And one was envy. He was envious of a person who was much more successful than him, at least on paper, and much less capable than him, which is probably true. And the second is, so envy is a very bad human trait. And the second is ego. And ego is nothing but a false sense of self. So, all of us are ashes and dust. We came from ashes and dust, and we will be ashes and dust. And it's useful to remember that. Or, like a good friend of mine always says, everyone burps and farts. So basically, if you were to basically eliminate envy from your life, and if you were to eliminate as much as you can ego, you're very far along the path of doing quite well. And so with that, I'll go ahead and get started, and we can start the PowerPoint. And so basically, I'm going to just talk about a very old Indian tale. Actually, most of us probably grew up with, and it's it's a tale about the invention of the game of chess. And so the game of chess was invented about 1400 years ago, 70 score and 4 years ago. And this guy who invented the game, when he showed it to the king immediately became a big chess fan and was playing all the time. And so he told the inventor of the game that, ask for any reward and it shall be yours. And so the inventor says that what I want is, I want you to put 1 grain of rice on the first square of the chessboard, and I want you to put 2 grains of rice on the second board of the chessboard, and I want you to put 4 grains on the third square, and keep doubling the grains on every square. And just when you get to the 64th square, then that is the amount of rice I'd like, and that's all I want. And of course the king thought that this was a very stupid request, and he said, I wanted to give you such a big reward and this is all you want, a bunch of rice. So he told his treasurer, measure out the rice that this guy needs and get him out of my court. And about a week went by and the guy hadn't figured it out yet, so he called the treasurer back in and said, why are you taking so much time? He said, well, it took me a while to run the calculation, and it turns out that we don't have the rice. Not only do we don't have it in our granary, we don't have it in the kingdom. And not only do we not have it in the kingdom, it doesn't exist on planet Earth. And that is the power of compounding. So if you took that amount of rice, which is going from 1, 2, 4, 8, 16, and so on, we have a bunch of people who are going to IIT soon. So how many grains of rice on their chessboard? Anyone raise their hands? Over here? No? Accidental raising of the hand? Anyone? Yeah, go ahead. 2 to the power 64 minus 1. Okay, I won't ask you to lay out the whole number. So if you calculate that amount of rice in terms of present rice prices, it works out to $300 trillion. And of course, 300 trillion is a big number. The entire net worth of every man, woman, and child in the United States is 70 trillion. And the entire net worth of every man, woman, and child on the entire planet is just about 300 trillion. So basically what the guy asked for would be pretty much the entire wealth of the planet. And that is the power of compounding. And that is why Einstein calls it the 8th wonder of the world. And this story of chess that I told you is something I'm sure most of you already heard before. In fact, I heard about it when I was a kid. And in 1994, I was 30 years old and I heard about Warren Buffett for the first time. And when I heard of Warren, I had really no knowledge of investments or capital allocation or any of those things. But what I was lucky about in '94 was the first couple of biographies on Warren Buffett had just come out at the time. And so I could look at this track record that Warren Buffett had from 1950 to 1993. It was a 44-year track record. And over that 44-year period, he had compounded money at 31% a year. And if you compound money at 31% a year, actually, as I'll show you later, if you compound money at 26% a year, it will double every 3 years. 1.26 times 1.26 times 1.26 is 2. And if you're compounding at 31% a year, you will double your money in little less than 3 years, maybe 2.5 years or 2.6 years or something. So when Warren Buffett for 44 years had compounded at 31%, he was already on the 18th square of the chessboard when I first heard about him, because he had compounded. And so, I thought back to the story about the chess and the rice and so on, and I talked about Warren, and I said, wow, this guy is actually playing out that chessboard story. And that story is very powerful because if you keep doing it, and if he keeps doing it, he's going to become the wealthiest person on the planet. And he became the wealthiest person on the planet. So it works. And but when I was thinking about all these things, like I said, I've never been to business school and really hadn't thought much about investments. And a few things kind of stood out to me. Basically, the investing world, hardly anyone followed Warren Buffett and his approach to investing in 1994 and even today. And hardly anyone had the returns that he had. So the investing professionals, if you will, did not follow Warren's approach to investing and did not have the results that Warren Buffett had. And I thought those two facts were cause and effect. I thought that the Buffett approach was the approach to kind of high rates of compounding. And if you didn't follow that approach, you were basically not going to go anywhere. And so I had these thoughts that these things were related. And so Buffett's approach looked replicatable, and no one was replicating. So I said, I like this compounding. I like this 26% or 31% a year, and why don't I give it a try? And how many of you have seen the movie Forrest Gump? So we get answers in the extreme front of the room and extreme back of the room. How many people in black shirts have seen the movie Forrest Gump? Okay, so when you go to IIT, on YouTube, download the movie and watch the movie. So you appreciate it. It actually won an Academy Award. It's a great movie. And I'm just going to play for you about 1 minute of the movie right now.
So I never went back to work for the day. So he did take care of my bubble gum money. He got me invested in some kind of fruit company. And so then I got a call from him saying, we don't have to worry about money no more. And I said, that's good. One less thing.
So, Forrest Gump is my hero. I like Forrest Gump. And, after I decided to do this, try to do this replication of Warren Buffett's compounding, I changed my license plate. And of course, I think I might have mentioned to some of the Dakshina scholars last time. But maybe for the people who are not in black shirts, what does my license plate mean? Maybe the ISB crowd can take a guess. So that's my real California license plate. That is on my real 6 Series BMW convertible. So what does the plate mean? Yeah, but how do you come up with that? How does it mean that? Yeah, go ahead. Someone asked you? No.
Compound like Buffett 26.
I'm sorry?
Compound like Buffett 26.
No.
Compounding at lower bound of 36.
Compounding at?
Lower bound of 36.
No, the LV is not lower bound. Anyone else? Yeah.
LB means pound actually.
Very good.
So compound.
Were you here last year?
Yes.
So you're cheating on the test. Okay, so the LB means pound. It's an abbreviation for pound. So compound 26. All right, so that's my license plate. I make sure I look at it every day. And so in 1994, I was 30 years old. I had just sold some assets in this business I was running. Still had the business, just sold a small portion of it. And basically I ended up with $1 million in the bank. And I really had no use for that money. It's the first time actually I had any kind of money in the bank. And at the same time I read these Buffett biographies and the chess overlaid with his 18 square. So I said, hey, why don't we focus on a very simple formula? 1.26 cube equals 2. Even I can handle that math, even though I didn't go to IIT. And I decided to play a 30-year game. And so the 30-year game I decided to play was that if you compound at 26% a year, your money is going to double every 3 years, right? And if it doubles every 3 years, then in 30 years it's 2 to the power of 10. What is 2 to the power of 10? 1024. So forget the 24. Let's round off to 1,000. So I had $1 million. The plan was to compound at 26%. And so in 30 years, I should add 3 zeros to that, because it's 1,000 times whatever you had. And so it becomes $1 billion, which is a better number than $1 million. And so I said, let's go for the $1 billion. And my thought was that even if I failed by 90% or 95% or even 97%, it's still okay. All those numbers are okay. So, so I decided I would play this game. And of course, my hero, Swami Vivekananda, told me, just like I tell all the Dakshina scholars, you just take up one idea, make that idea your life, think about it, dream of it, live on that idea. Let the brain, muscles, and nerves, let every part of your body be full of that idea, and just leave every other idea alone. That is the way to success. And so I think Swamiji said that for my benefit, to compound money. That's my take on him anyway. So this is what happened. In 1995, I started putting that $1 million to work. And for the next 4.5 years, from 95 to middle of June or middle of the year in 1999, it actually grew at 43.4%, way above the 26%. And the 1 million had become 5.1 million. So I said, all right, man, I knew this could be done. We got it done. And then, I had all these friends. I used to tell them, different stocks they should buy, and they used to make a lot of money with all the stock tips I used to give them. So they came to me and said, listen, this stock tip business is very random. We want you to manage some money for us, and then you do what you want, and we can have some benefit of that. So in July 1st of 99, I set up Pabrai Funds, and it started with $1 million from 8 friends of mine. I also put in 100,000. And from 99 to 2007, middle of 2007, 8 years, Pabrai Funds compounded before fees at 37.2% a year. And of course, I get paid outrageous fees. And so after fees, it was 29.4%, but both numbers are perfectly fine. So now, more than 12 years have passed since I started this, and things were working, going really well. Again, patted myself in the back, doing well. And then all hell broke loose. And for the next 21 months, we compounded at minus 47.1%. And I can just tell you, if you compound at minus 47.1% and the car starts going in reverse, the same thing happens in reverse really fast. Thankfully, that came to an end in 2009. And then for the last 4.25 years, we've been compounding back again at about 32.8%. So now it's been 18 and a half years. Actually, the slide is wrong. It's 18.5. But the numbers are right. It's 25.8%. So we undershot by 0.2%. But we still have 11 and a half years to go. Maybe I can make that up. We'll see. So it's pretty close. And of course, the good news with investing, unlike tennis, is the more you play the game and the older you get, the better you get. So this is a game where over time you get better, so that's great. All knowledge is cumulative, that's also good. And of course, what the things that we own in the portfolio is very undervalued, so I think it'll do well in the future. And I'm excited to see how the next 11 and a half years unfold. And so, how does one compound at 26%? Well, you cannot compound, you cannot beat the index by trying to beat the index. You have to try to do something different from what the index is doing. And basically, you make very few bets, you make very big bets, and you make infrequent bets. And you make bets when the odds are heavily in your favor. And in this business, you can be wrong a lot and still be okay. I mean, if you look at my record, I had that 21-month period where we actually had several investments go to zero, and we still look fine after that period. And of course, this is going somewhat off topic in the sense that we could do a separate presentation on each of these things, but you know, if you focus on things like cannibals, companies that are buying back their own stock, or spin-offs, or clone what other people are doing, what other great investors are doing, which is what I do a lot of, things become a lot easier. And basically, the other thing is that, you know, I don't make investments unless we have at least the prospects of a double or a triple of the money in 2 or 3 years. And as the amount of money in the portfolio goes down, that number keeps going up. So for example, with the last 5% of assets or last 10% of assets, we need at least 5x or more. So that just makes sure that the money goes out during the most distressed times. And of course, after 2009 and 2008, when I got whipsawed, if you will, I made some changes. So one of the things I came up with was this pre-investment checklist, which has been wonderful. In fact, our error rate is almost zero since 2009. We have hardly had any losses of capital, and that makes a big difference. And the second is that I started having conversations with a fellow fund manager, and that was actually investment advice I got from Charlie Munger, who said that he always had somebody to talk to. And until 2008, actually, I never talked to anyone about my investments. But now I always talk to this one person who's exceptional, actually. And it's worked out very well. And we don't always agree. In fact, we disagree a lot of the time. But the conversations are still very helpful. And so that's pretty much the song and dance. You just need to take a simple idea, you take it seriously. Compounding is the eighth wonder of the world. You want to be a cloner. I have no original ideas. Basically, in many different ways, I copied Warren Buffett. And then, of course, you have to come up with your own license plate. And what I'm going to do now is I'm going to play a 5-minute Bollywood video for you to put you in a better mood. So we'll play the MP4, but maximum volume, and take the lights down. Thank you. And then we'll take your questions. We'll take your questions, and I think we have a couple of mics. Maybe if someone can just take the mics around, then all of us can hear the question. And you can ask things that are in the presentation, and I hope you ask things that are not in the presentation. So pretty much you can ask anything you want other than what I'm buying right now. So.
Friend of BGP here. Okay, my question is, you said it is replicable, the theory of welcome is replicable. But if it is that easy, why not everyone is doing that? And another thing, how do you do that? For example, you say 75% of the fund is invested in industry which would become 2x in 2 to 3 years. But how do you decide that?
Okay, so let me start with your first question, because that's a very deep question. So you say, like you said, I said it's replicatable, but no one is replicating. So it took me a long time to figure this out, and I'm just about getting close to figuring it out. So there is something strange in the human genome, and that something strange makes people, and the good news is we have some time, so I can give you my expanded answer. That makes people very much opposed to being intense copycats. So humans, most humans, do not want to do cloning. And they do not want to do cloning because they consider it beneath themselves. And of course, low-life people like me do not consider cloning beneath myself, and so I'm willing to do it. So to give you an example, if you look at a company like Microsoft, Microsoft isn't even that great a cloner, because anything they work on takes them about 3 or 5 or 7 versions to get it right. Sorry, Ashok, maybe you can make it better for them. But it takes them a long time. But bottom line is that most of Microsoft's revenue comes from Windows, which was cloned, comes from Office, which was cloned. PowerPoint was actually bought from another company. Word was lifted from WordPerfect. Excel was lifted from Lotus, and so on and so forth. And even SQL Server was lifted from Oracle, and it just goes on and on. You can look at Microsoft Money, you can look at Bing coming from Google, and so on. So bottom line is that Microsoft isn't even that great a cloner, but it's one of the largest and most successful companies out there. You look at another company, and this is something that really perplexes me, is a company called Walmart. And so Sam Walton, the people who knew him well, founder of Walmart, they would not call him a brilliant man. He was not someone who would have been blowing off IQ tests, and I think most of the people in this room would have a higher IQ than Sam Walton. But Sam Walton, if he were alive today, he would have a net worth of about 150 billion. He'd be the richest person on the planet. And Walmart, for the first 20 years of its existence, did not come up with any innovation. All Walmart did was they looked at Kmart's model and they looked at Sears' model, and they replicated that model. That's it. And in fact, what I find really funny is in India, we have this big debate going on about letting, I'll just digress for a second, foreign retailers in so that they can make things more efficient. And then they talk about Walmart coming in. There is nothing in Walmart's business model that anyone cannot look at by walking into a Walmart and replicating it. India does not need Walmart to come in order for retail to become efficient. India just needs an entrepreneur to look at that model and replicate it. That's it. There's nothing else needed. So there is nothing special about Walmart's model. There's nothing special about Microsoft's model. And it goes on and on. McDonald's, for example, they have a whole army of people, whole departments, which spend all their time trying to figure out which is the next location they should put the next McDonald's in. They do a lot of studies and analysis to figure out demographics and all that. In the United States, Burger King, which competes with McDonald's, has 2 people figuring out locations. And all they do is look at where McDonald's is putting their locations. And it's a very powerful strategy. So they look at, oh, McDonald's is opening up in Peoria, Illinois, this corner. Okay, we'll take real estate in that corner, we'll open up over there too. They've done all the work, so they must be working. And it's worked really well for them. So the thing is, the Walmarts of the world, and the Burger Kings of the world, and the Microsofts of the world are a rarity. Most people do not want to do cloning because they think it's low. So in fact, even when I looked at Buffett's model, when I set up my own investment partnership, the Pabrai funds, I replicated the Buffett partnerships. And he closed his partnership in 1969. I opened my partnership in 1999, 30 years later. In 30 years, I could not find one example of a single fund anywhere in the world that had replicated the Buffett model, which was the most successful hedge fund ever created. Nobody replicated a model that ran from 56 to 69. And there were books published, the books I read, and the books had sold millions of copies and they got printed in many languages and all of that. So and the model was very simple. There's nothing special about the model. But and even today, forget 1999, today is 2013. I've been running Pabrai funds for almost 14 years, actually it's been 14 years, over 14 years. And I've spoken at so many business schools and so many different places, and I've answered questions like you've asked. And I've asked the business school students that, listen, there's no point paying fees to ISP. I'm sorry, have they already collected fully in advance? Pardon? Half. So you can still save half. Sorry, Vikram. I'm sorry, this is not an ad, but you can still save half. What you can do is, you don't need to even listen to the rest of the boring Q&A. You can walk out right now and start replicating. And every time I say this, nobody walks out. They want to keep paying tuition. So anyway, so first of all, the only thing I can figure out is there's something in the human genome that makes cloning very attractive to maybe 1 or 2% of the population, if that, or probably less than that. And for some reason makes it very unattractive. So I have found, because I've understood this, I have adopted cloning in a very serious manner. In fact, on my gravestone, they will write, and I hope they write, he was a cloner. That's it. In fact, if you look at even Dakshina, our model that works so well, it's not a model I came up with. I could never come up with such a good model. I'm too stupid to come up with a model like Dakshina. It was lifted from Super 30. So Anand Kumar, great guy, came up with a great model. Just like Kmart came up with a great model and McDonald's does a great job. And all we had to do was, I asked Anand Kumar, hey, do you have a problem if we clone your model? He said, no, I'll help you. So I said, okay, great. Now I can even clone and the guy wants to help me. So it's great. So that was the first question. What was the second question?
How do you actually do it? For example, you said 75% of the stock is invested in the...
Yeah. So that's the crux. The real question, kaise kar rahe ho? Okay, all right. I'm glad we're getting to the core issues right up front. So, I don't have a newspaper in front of me. I should have brought one. But because one of the things, in fact, I'll do it maybe in my next presentation sometime, is this is my plan for my next presentation to answer that question. I want to take the Economic Times or Wall Street Journal or whatever, and I want to create a dartboard out of all the stock quotes page. Create a dartboard. Maybe I'll actually create a real dartboard. Have some unpaid intern do that. And then what I want to do, I want to take a dart and throw it at that dartboard. And whatever stock it lands on, I want to take that stock and just give you the statistics of that stock. So let's say, let's take a company in the US like General Motors. Huge company, car company, I don't know, close to 200 billion in sales, 150 billion. No, I think 200 billion in sales. So if you look at the 52-week range on GM, General Motors, and you can do the same thing with Infosys, you can do it with Tata Motors, you can do it with any company. You can just throw a dart basically. And what you will find is that in 52 weeks, which is in 1 year, the time it has taken the Earth to go around once, General Motors was at one time being valued at $18 a share. And in fact, just yesterday, it hit a 52-week high. It's over $36 a share. So in 1 year, on this one stock, you have basically pretty much 50% movement. I mean, it would, you basically double the market cap from a year ago or whatever. So, and the business, the underlying business, has not changed that much. Okay, if I look at Infosys, I don't know, you guys, what is the price of Infosys right now?
2800.
I'm sorry?
2800.
2,800 rupees? And what is the 52-week low on it?
Around 2200.
Okay, and what's the 52-week high?
I guess it's the high, if I'm not wrong.
So it's 22 to 2,800,
Yeah.
right? Okay, so you have a range of like 30% or so, okay? The reason you have these ranges, now if you look at any other asset class, so let's say I have a 3-year-old Maruti car, okay? The price I could get for that car a year ago, a 3-year Maruti, and the price I can get today, again, the same 3-year-old Maruti, maybe within 5 or 10% of each other. Okay, even for the most part, real estate movement is low. Stock markets are different creatures, and the reason they're different creatures is because they are auction-driven markets. So you don't, in the case of a car, you have an intelligent buyer facing an intelligent seller. And between the intelligent buyer and intelligent seller, they will arrive at the price of a car. That makes sense. And if they don't arrive at an intelligent price, there will be no transaction. So both sides have to agree. In the case of the stock market, you have basically faceless buyers and faceless sellers. And you have an auction-driven mechanism for setting pricing. And auction-driven mechanisms, by their very nature, are set up to create distortions. And Warren Buffett has benefited big time from those distortions. So if there was no stock market, Buffett could not have done what he did. If, let's say, Warren Buffett were restricted from 1950 till today to only buy private companies from intelligent sellers, no way anywhere close to what the record is today. It is because we have this mechanism of this auction-driven market that we have this distortion. So if I went to buy GM a year back and I went to them today, the price will not change 100%. Okay, it will change 5%. Even if in the case of Infosys, you go to buy the whole company and they give you a price today, and you go to them 6 months from now, the price will not change that much. So bottom line is that it is the auction-driven nature of these markets that causes these wide distortions. And the second is that especially when there is extreme fear or extreme greed, you will get attenuation of that distortion. So Infosys is something, for example, which is a blue chip company. But what if I pick something that is an obscure company? Let's say I pick some, regional jute producer in Calcutta, something 100 crore market cap type thing. It will have a wider distortion. Okay, but that same company, if you go to do a private transaction to buy the company, you're not going to have those distortions. So the stock market is set up for cloners like me to have a field day. So, same thing you see in the public markets. Facebook comes public, everyone's excited about Facebook, the stock price goes up like crazy, and then a few months later, no one's interested. And that goes on all the time. So markets are constantly overshooting, sometimes where they significantly overvalue the companies, or they're significantly undershooting, where they're significantly undervalued. And because of the significant over and undershooting, you can sit there. So bottom line is that if you have that much of a swing, 50%, 100% type swing in a year, it means that there are enough companies out there that are not correctly priced at any given time. They are either underpriced or overpriced. And especially if you overlay on top of that distress, some kind of temporary situation which affects that business, that will cause even more attenuation of the pricing. Because the other thing that's happening in public markets is that any company typically in about 2 years, sometimes in 1 year, sometimes 6 months, the entire turnover shareholder base changes. So people aren't even holding the stocks that long. So all of these things basically mean that some yo-yo like me can sit there, spend most of my time talking to you guys or hanging out with Dakshina scholars, and every once in a while I see distortions of an extreme nature. And when I see distortions of an extreme nature, then I act decisively. And I don't even need to be right all the time. I can be, in fact, John Templeton, who was a great investor, said that there is no investor who's right more than 2 out of 3 times. So you can be wrong plenty of times, and you can still do fine. So, so I think that you know these distortions take place all the time. I think if you understand the business really well, so the first most important thing is circle of competence. Stick within things that you understand really well. If you understand things really well, you know what they're worth. And when the world is valuing it much below what it should be worth at, that's when you act to buy. And when the world is valuing it significantly above what it's worth at, then you sell it and you're done. Nothing else to do. So maybe you have 2 or 3 buys a year, maybe 2 or 3 sells a year, and we move on from there. Next question.
So my doubt was basically in, like, you said that evaluating a potential buy is by throwing a dart.
Yeah. No, please. Abhi, you're putting words in my mouth. Did I say that? I just said by throwing a dart, I can demonstrate to you the wide distortions that take place in stock prices. That's not how I pick stocks.
So then, like, what would be the metrics you use? Like, what financial reports would you use for evaluating the potential? Like,
so number one, I do not throw darts to pick stocks. In case that was not clear, so I don't do that. So let me give you some data points that might be useful. There were a couple of professors in the US, I think one guy is at the University of Nevada, another guy is at Ohio State, and they wrote a paper where they looked at every stock Warren Buffett bought for 30 years, from 1975 to 2005, 30-year period. And what they did is they did an analysis. They said that, okay, if you bought what Buffett bought, and you bought it after it was publicly known that he has bought it, and you bought it on the last day of the month that was publicly known that he had bought it, and you bought it at the high price of the last day of the month, so the highest price it traded on that day, which means that you go and find the worst possible broker on the planet and say, please give me the worst possible price you can get, and I want to buy it at that price. And then you held it till Buffett started selling the stock and it was known publicly that he was selling it. And you sold it on the last day of the month that it was public. And the price you got when you sold it was the lowest price on that last day of the month. And you did this for every stock that he bought and sold for 30 years. If you did that, you beat the index, the S&P 500, by 11.5% a year on average. And the S&P had done about 10% historically, so you were doing about 21.5% a year with no ISB degree required. And so again, you can walk out of the room right now and you can put this strategy to work, because again, I've told so many business school students about this strategy, and so far nobody has set up a fund to do this. And like you were saying, why are they not replicating? Exactly. Why are they not replicating? So it's still not too late. You can start a fund tomorrow which does this. And what you do is you take a villa in Goa and you just go on vacation every day. And then the last day of the month, you come back from the swimming pool and just look at, okay, has Warren Buffett bought anything? Oh, okay, he bought IBM. Okay, chalo, we'll buy IBM. Then you go back to your ocean surfing and swimming and whatever else you're doing in Goa till the end of the next month. and you're done. So the bottom line is that cloning, which I talked about, is a very powerful notion. Unfortunately, no business school professors have ever written any books on cloning that I'm aware of that are any good. And there are a few books on cloning, but they miss the point, I think. So bottom line is that, so if you did what Buffett did, what these professors said you should do what Buffett did, you are already beating the S&P by about 11 percentage points a year. Now, most of what Pabrai Funds has done, at least for the last several years, is, in fact, if I look at my portfolio, almost everything that we own was copied from some other great investor. But please don't tell anyone. Let's keep it a secret. Okay? Are we recording this? Vikram, are we recording this? Okay, so we just keep it for internal use. All right, don't put it on the web. We only want ISP to have an edge. Okay? So anyway, so the thing is that if you were to, so basically what I am doing, you can say is a slight tweak to the paper that these professors wrote, where basically if you set up a fund, and all the fund does is clones the ideas of other great investors, but the only layers I add to that is, I don't buy everything that the other greats are buying. I look at what they are buying, and then I look at the ones that I can understand. And the ones that I can understand and figure out, yes, this is very undervalued, and yeah, I think he's right about why he's buying it, those are the ones I'm buying. And that's it. And basically, limited to 2 or 3 decisions a year. That's it. So, not much else required.
CS Balachandra,
Yeah.
Company Secretary.
I don't know where you are. Can you just raise your hand? Okay, great. Yeah.
I just wanted to understand the relevance of putting the topic of investing and philanthropies. This is the topic we received.
Yeah.
We are yet to hear about philanthropy.
So if you ask me, we can go there. Do you have a question on philanthropy?
No, we just wanted to hear some thoughts on philanthropy also.
Okay,
Because
sure.
we just heard the investing related issues,
Okay.
compounding and all.
Actually, what you will find, and I'll maybe digress for a few minutes, and not even digress, but I'll go into it for a few minutes. What you will find is it's the same as investing. There's really no difference. So, my personal biases of philanthropy, which I get to play out in Dakshina, are very simple. Basically, first of all, I feel that my father used to say, "Nange aaye hain, nange jana hai." We come to this world naked. We're going to leave this world naked. And so, since we have to leave the world naked, then the question comes up that if you end up with more assets than you need, what do you do with them? And probably a lot of it, because of Warren Buffett's influence, I think that for most people the best thing to do is to recycle it back to society. And so if you decide that you want to recycle excess assets back to society, then the question becomes, how do you do that, and what do you focus on? And so some basic principles. Number one, which comes straight from investing, is that if you were looking at 2 different charitable endeavors, endeavor A and endeavor B, you ought to be able to figure out which one delivers a higher return to society, if you really understand them. And once you figure out which one delivers a higher return to society, what you ought to do is put all of it into the higher return endeavor. So the first thing about philanthropy, my philosophy is, you do not do sprinkling. You do not say, I'll give some money here, and I'll give some money here, and I'll give some money to this temple, and I'll give some money here. No, because that is really not going to maximize and optimize what society's benefit is. So first thing is, it has to go single cause, and it has to go to the cause that has the highest possible returns. And In my case, it was very easy to come to the conclusion that that is likely with investments in education towards alleviation of poverty, because I think that education has this a huge multiplier effect. So then you get to the point of saying, okay, I want to invest in education. I want to, instead of giving a person a fish and you feed him for a day, you teach a person to fish and you feed him for a lifetime. And so then the question comes up that if you want to teach fishing, what type of fisherman do you want to create? And so the model Dakshina has adopted is a very high ROI model, because we have a partnership with the government of India. They do most of the heavy lifting. And we get to add on top of a great model. And the returns we get on the funds that we invest, I think, are off the charts. And in fact, to demonstrate that, maybe I can have Ashok come up. Ashok, can you come up for a second? So Ashok Kumar is a Dakshina scholar who is a IIT Bombay student, and you finished 2 years or 3 years there? 3 years. So he's finished 3 years at IIT Bombay. He's actually from Gachibowli. He grew up here, right? And in fact, I visited his home in Gachibowli with my daughter a couple of years back, I think 2 years back. And so Ashok's father is a tailor, and I think it's a lower class area where, lower economic strata area where he practices a profession. Very, very modest dwelling. In fact, when I went to this home, my daughter and I could sit down on 2 chairs. The rest of the family had no chairs to sit on. And in fact, we were served tea on a very small stool, which could probably hold maybe just the 2 cups of tea and some snacks. And so Ashok basically went to the Jawaharlal Navodaya Vidyalaya here in Gachibowli. He got picked by us in 10th grade because he cleared our selection test. We worked with him for 2 years on IIT prep. And then after 2 years, he took the IIT entrance exam in 2010, right? And his All India rank was 63. 63 out of, 500,000 kids who took the exam. So we should have that and it's a single generation transformation in my mind from zero to hero of that family. And in terms of what we invested, we could never do that for the family if we were not riding on a great platform. And Ashok is now interning at Microsoft, also in Gachibowli. And basically, I think the future of his family is going to look very different very soon. So I don't know if you want to add something, Ashok? Go ahead. Maybe you can answer this question. The question is like, philanthropy, like, what do you think of the Dakshina model? What do you think we're doing in this work?
Hi, I am Ashok Kumar. I stay in Chandanagar here. In my 10th class, I wrote my Dakshina entrance test and it got selected. That Dakshina is it's a foundation which helps the poor students who cannot afford for JEE coaching, and they'll help you get it free of cost. And I came from a poor background, and I don't think my parents would have given me coaching at that price. I would have continued my studies without any coaching, and I would land up in some local college here. But really, it's because of Dakshina I am in this position now, and I am proud of it. I'll be completing my 4th year. I'll be graduating the next year from IIT Bombay in Computer Science department. I recently interned at Microsoft. Yesterday was my last day of internship there.
Okay, so next question. Hi. Yeah, go ahead, sorry.
I had a question on back on the investing side. My name is Tom Highland. I am an ISB alum, and I manage an early stage venture capital fund focused on nuts and bolts businesses here in India. I just had a question. You put up a slide earlier around your fee structure, and there was something 800, 900 basis point difference between your net of fees and actually your return.
Yes.
I'm curious as to how that works, whether that's a
My investors love my fee structure. In fact, if the entire fund industry adopted my fee structure, the industry would disappear. So my fee structure, which was copied straight from Warren Buffett, is there are zero management fees. I don't get paid anything for assets under management. The first 6% of returns go to the investors. Above 6%, I get 1/4 and they get 3/4. So if you're up 10%, I get 1%. It's subject to high water marks. If you're up 5%, we get nothing, and if you're down, we get nothing. And like I said, if the industry adopted that fee structure, which I would love them to do, they would just disappear.
And the second part related to that is, I mean, not everyone is a natural stock picker or a cloner. So for those that want to build wealth and perhaps just buy into the S&P, I mean, do you subscribe to a Jack Bogle view, just buy an ETF, buy a fund with a very low load and kind of set it and let it go?
Yeah, I mean, I think that, there are, I give this talk, I say that, let's say you had a 70 IQ and you say that, hey, I want to do the best I can. So I would say, okay, 70 IQ, you can buy an index fund. And then someone comes and says, hey, I have an 85 IQ, I'm better than the 70 IQ guy. Can you do better? Can I do better than that? I said, yeah, of course you can do better than that. You can buy Berkshire Hathaway stock and just hold it. High probability of doing better than the index. And then someone says, well, I'm a 100 IQ. Can I do better than the 85 IQ? And I say, of course you can. And then I say, just read the paper by those two professors and replicate that. And then someone says, I have a 120 IQ. And then I would say, why don't you just do what I'm doing? And above 120 IQ is useless for investing. Any other question? Yeah, go ahead.
Hi, my name is Raj. I'm an ISB alum. 2007 to 2009, when you had negative return. My question is, obviously you guys analyzed what happened. So what went wrong and what amends were made after that?
I'm sorry, repeat. So what went wrong?
Yeah, what went wrong with